Hello everyone, can you hear me? This is Nektarios and we're about to start our webinar today, so you can give me a heads up that everyone can listen. Would be very happy. Anyone? Nobody can listen?
It's really slow yesterday, we thought somebody commented. It's really slow, I had that same problem yesterday. Just assume that they're there.
Guys, can you hear me? Yeah, audio is okay. There must be some delay from the, yeah. Okay, thank you very much guys for the heads up. So, welcome to our webinar called the Key Elements of a Trading Plan. As you will see over the course of this hour, we will go through what constitutes the key elements of a trading plan, and how we should essentially keep a journal. And we will see how this will go shortly. So, if given the fact that you can hear me, so if anyone has any issues, please check your audio visual devices, and otherwise let me know, and maybe I have done something, or maybe something's wrong with your devices. We can hopefully sort this thing out. The idea is that you can check your settings, let me know through the chat window, and if in any case I missed some questions, or you would like some more details regarding anything you have seen on this webinar or any previous webinars, please feel free to email us directly at webinars@hotforex.com. Short introduction about myself. So I have about 4.5 years of experience in the Central Bank of Cyprus, where I have obtained a hands-on experience with real-life economics, and I support the idea of a balanced approach between science and art when it comes to trading opportunities across various asset types, meaning across any financial instrument. And the idea between science and art is that we need both good judgment, which is all what art is all about, and very good um, very good very good implementation, having a correct trading plan, so we can go on with this. So I have a PhD in financial economics, and I have also researched topics regarding the macro developments and stock market returns, trade balance, exchange rates, and other issues on economic policy, etc. So kindly note that the material provided in this webinar is provided as a marketing communication material. It's purely for information purposes and does not constitute independent investment research. And nothing in this communication contains or should be considered investment advice, or an investment recommendation of any kind, or even a solicitation for the purpose of buying or selling any financial instruments. So all information provided here is gathered from reputable sources, and any information containing an indication of past performance should not guarantee or be a reliable indicator of future performance. So you need to, as we also always underline, that our users need to acknowledge that any investment in forex and CFD products is characterized by a certain degree of uncertainty, and any investment of this nature involves a high level of risk for which the users are solely responsible and liable, and we assume no liability for any loss arising from any investment made on the information provided in this communication. So what we're going to cover today is mainly one of the key elements of a trading plan, which is why trading journals are important, how to keep a trading journal, why having a simple journal is the best option you can have, and how you could benefit from this, and how this should help you uh, complete your investment targets. As always, there is a Q&A section at the end of this session, but feel free to write me something at any point just to clarify something you may have missed, or something that makes no sense the way I said it, or something that is unclear. So please feel free to let me know. So let's start now. Why trading journals are important? So to begin with, let's see what this trading journal is all about. So a trading journal is really a log of what you do. It serves as a reference manual and a personal encyclopedia, in the sense that it gives you it offers you an insight into what you were thinking at the time, what you believed, and what you thought, and how you thought markets would move at that specific point in time based on your trading plan. To this end, a trading journal can help as a guide, as a coach, and your own guru if you prefer, in the sense that it helps you understand yourself and understand your trades. The above two basically allow you to grow as a trader, adapt to what you're trying to achieve, and be flexible with your skills. Okay, so overall, a trading journal is quite important, as you will see in a bit, for the simple reason that it can serve as a it can give you a very good insight into history, to your own history, really, to your trades history, as to how you played, what you did, and help you understand where you made a mistake or where you did well. What were your thoughts at the time? What were you thinking? What crossed your mind? What triggered your trade? And everything. So remember that even in chess, professional players do tend to keep a log of what they're doing in hopes of improving themselves. And this is actually something that many professional chess players recommend with regards to ways of improving one's play. So this is the same. It's the same idea here. It helps you understand yourself. It helps you see what triggered you to do your own moves, and should provide you more intuition about who you really are. So the idea behind this is that despite of how good we may be, uh, it is often the case that we can be wrong. Okay, there have been stories of traders. I've been reading a very nice book lately called More Money Than God, The History of Hedge Funds, where the author, Sebastian Malaby, comments about a particular trader who says that he's correct less than 50% of the time, but still earns a significant return on their investment. On the other extreme, Nassim Nicholas Taleb comments that his approach to investing allows him to bleed a little every day, meaning lose small amounts of money every day, but win big in occasional trades, and thus he still remains on top. So what this means is that it's okay to be wrong. It's okay to be wrong often, but you can be wrong and often only if you can manage your risk correctly. So the idea is that in order to be able to manage your risk correctly, you need to write everything down. This requires quite a lot more information than the logs and or the emails you get from your broker or the details on the MT4 platform. So when it comes to professional traders, many of them have managers or computer software which allows them to monitor their activity and risk. The average trader doesn't really have any such luxuries. So a journal is the best way to write down what goes on in your market. So one of the key things one would want to identify about himself is strengths and weaknesses. So patterns will emerge, and you will see that some you are better equipped to make trades in some particular instruments. So, for example, you could be better at a better trader in FX than in commodities, or it could be the case that even more specific that that one trader understands how to trade the euro dollar more successfully than he can do with the euro yen. So a trading log will help you do this thing. So the problem is that many traders continue to trade on things they do not earn money in. So the problem with us people is that we usually have short memories. So when I invest again in euro yen, it may be the case that I don't really remember that I have thus far made just a large amount of losses. So if I continue to do this, it is most likely the case that I will continue generating more losses. However, the trading log will tell me that, you know what, you've had 10 trades on this, you've lost every time. What goes on? What's the problem? What appears to be different in this currency? Is it the fact that this particular currency is not good for you? Is it the fact that you've made an error of judgment? Is it the fact that the system does not fully apply to the fundamentals or the overall history of the pair? What goes on? So it is important to understand and be able to distinguish between a trade that simply doesn't earn doesn't offer us any return, and one that we just didn't trade well. So if we have a good system and a couple of times we chose not to obey by that system, then it's not the system's fault, it's not the pair's fault. However, it's our fault, right? So we have to correctly assess this thing and be able to examine whether we can improve on this aspect. However, it could be the case that our system does not operate very well in a particular market. So maybe our system works perfectly for forex markets, but it's very bad for indices. Or it could be the other way around. It works perfectly for the USA 500, but it fails spectacularly when it comes to trading the euro dollar. So the issue here is that we need to record everything, what we were thinking at the time where where we entered or exited or closed the trade. So, for example, using a simple trading extra from the MT4 platform, as you can see here, this was a position that was on the euro Swissy, and it's not really that helpful. The idea is that it is quite important to observe that the information we get from the broker or from the email we get is that it is marginally useful, as it doesn't really tell us much about why we entered and exited a particular trade. So in this case, it's not very helpful to to understand our own behavior. So the idea of a trading journal is that it helps us understand and refine our methods and mastering our own psychology, which is the most important part when it comes to trading. Let's look at an example now. So for example, what did we say here? This is an excerpt from Copper, where the trader here suggests that he should enter the position and go long when it comes to when it hit this level. So the trader in this case decided that he would enter at once it hit 2.1130. So as it hit here, the trader bought. Now, why did he do that? So according to his notes, it appears that it has hit it has broken the mid of the Bollinger Band, and it appears to be heading up as supported by the previous candles. So in addition, there appears to be a weakening of the dollar. It appeared to be a weakening of the dollar during the period and a strengthening of commodity currencies. So this would imply that commodities would also rise. And then the first target, and then this was the minimum of the trade, and this is where he believed that the minimum would be. Thus, it would not be much of a problem. It would have enough space to move about. So this is all written down. So as you can see, our trader here says that, okay, I'm entering at 2.1130, and my first target would be something in the area between 2.1650, 2.1820. So this should be about here. Now, how you get to this estimation is, of course, specific to the trading plan you are following. It doesn't matter it doesn't matter how this trader got to this position. All that matters is that this is the target this trader believes according to his system. Now, of course, the trader has to write everything down, because this system could be based on something that worked and made sense when trading forex. It could be the case that this doesn't work in the copper area. Okay, so what the trader should write down is what cost him to enter the position here, what cost him to put the target level up here, and what cost him to put the extra target up in this level here. Okay, so the idea is that it should have a rationale for following this strategy. Now, what this means is that the trader should be like a record keeper. In essence, this should belong in the daily routine of the trader and does signify discipline and patience. In essence, keeping a good and a sensible journal is like having your own coach or mentor. However, you need to be honest. What do we mean by honest? We mean that you need to write what you felt at the moment. You need to be true to what triggered you to move, and you need to analyze everything about yourself. So if you're not good and you're not honest in doing these things, then it might as well not keep a record. So it much helps you identify how you felt during that period, what triggered you, what caused you to close a position afterwards, whether it hit the target or not, and a variety of other conclusions which can be drawn from the overall study of our trading journal. So a well-kept, detailed forex trading journal can be almost as good as having a coach watching you over your shoulder, and most importantly, helping you learn those lessons. Indeed, keeping a journal may seem boring and time-consuming, but a forex trader can often learn more from reviewing their own trades than from reading a book or even attending a seminar. So the idea is that you learn much more about yourself, which is something you don't really learn from a book, and it's quite hard to learn this from a seminar. Over time, you'll see that the journal will draw with you, and if you keep having detailed records on everything about your forex trading, so stemming from psychological issues, market environment, any tweaks you have found in the system, it will help you recognize important lessons such as what news events should be avoided, how much more or how much less you need to trade, and how much risk you need to assume, when you should start trading and when you should stop trading, and how disciplined you are with your trading journal is actually a good predictor of your overall performance down the road. In essence, if you cannot commit to writing it to keeping a trading journal, how can you actually believe that this is going to continue down the road? So this, as you can see, the trading journal is quite important. One other thing that makes it even more important is the fact that it makes the size of the account irrelevant. So you can have $500, you can have $5 million. It doesn't make a difference. Why? It doesn't make a difference when it comes to keeping a journal, because it helps you understand yourself. You should, in theory at least, and most often in practice, be the same person when you're trading, when you're throwing a small line than when you're throwing a bigger line. So if you're assuming too much risk, for example, and you expect to, then you should actually have a short life as a trader, as your account will empty much sooner than if you're taking moderate amounts of risk. So if you analyze your trades, you will see the patterns in you, and you will see your trading, your behavior more clear. This suggests that once you understand where you failed. So for example, it could be the case that in one case you invested 5 lots instead of 0.5 lots, or 5 lots instead of 1 lot, where in essence you assume much more risk than you should. So you were doing well, and then in one trade you assume much risk and you ended up losing money. This is exactly what we were saying before with the traders. So if the traders we were talking about before lose on average more than 50% of the times, but their losses are very, very small, then it doesn't make a difference. They should be able to gain a lot of money from the market. Okay, so a disciplined trader excuse me, is a profitable trader, and keeping a journal is the first step to help you build your discipline. So a trader the trading journal makes two very important points. The first is that you need to put discipline in your life. You need to be organized and disciplined. The second is that uh, it it could make you more profitable, as it will help you understand yourself. Also, one very important adjustment is that the the trading journal offers a great way to adapt and tweak your approach, your system, but only after time, of course. So once you have a large enough amount of trades, then you will start to see whether this can help you improve your own trading plan. So, for example, if you see that we have an effect from uh, our system triggers too early, then you will understand that you will see this in your trading log. Or if, for example, the system triggers a bit later, or if your target is set a bit differently, then this could tell you that you need to adapt, tweak your system a bit, change a bit on your approach, and it should help you generate a better understanding of yourself as well as your system, and help you improve overall. You guys have all been very quiet, which I presume is either because I'm very clear or because you're not paying any attention to me. I really hope it's the first. So let's see. What are the 5 elements that we need to observe in a trading journal? So the first one of the 5 important things is that we need to have a potential trading area. So where we intend to trade. This is where we intend to go in. This is where we intend to go out. And explanations on why we should do this. Then we have the entry trigger. What caused us to continue our what caused us to enter the market, or what caused us to short, what caused us to go long, what caused us take an action in that specific market. Then the position size. How many lots are we considering purchasing? Is it as small as 0.01? Is it 10 lots? How much did we commit to that trade? Then we have trade management rules. How do we manage our trade? Where do we put our stop losses? Where do we put our take profits? How do we justify this? Then once the trade is over, we see this trade retrospective. What do we think about the trade now, after the event? Do we notice any significant differences? Do we notice any particular changes in our mindset? Do we see now something now that we should or could have done differently? Naturally, notice something. These are guidelines, guys. Maybe you want to include more, maybe you want to include less. We're all different. However, you should put down what's important for you. You are the one who will benefit. You are the one who should make money from it, or stand to lose money from it if you do something that doesn't help you. Just note that the most common error made by active traders is to simply put into the journal the stock or the instrument they have traded and whether or not they made money or not. This is not what you're really trying to accomplish here. So the whole idea is to document your progress. It doesn't matter for the journal if you made money or you didn't make money. What matters is what cost you to do that trade, what cost you to exit that trade, and what triggered these things. So what should be, again, I repeat, the true goal of our journal is to document our progress. So we need reasons for the trade before we enter. We need our stop losses. We need our plans for the profit target, and we also need the dollar amount we intend to risk on this specific idea. Now, this is an example from Stuart's own blog. So as you can see, this is very simple. He just wrote down what he traded, what was his target, and how these things and how these move. So this is a simple example of how we can have a trading journal. A slightly more complicated journal, which you can also find in the handouts of this webinar, is this. So in this case, the trader used something slightly different. So for example, these were stocks of British Telecom, and he had 5 different points he would mark down every day. So for example, he would note down whether British Telecom, in this example here, went up or down. So on Monday, it appears it went down by 5 points. The close price was 253. The next support or resistance level, so this is 284. So this should be the next resistance level. And the next target is 234. So as you can understand, this is a short position. Okay, so given that the market close is 253 and our target is 234, what we can observe is that this is a short position. Finally, this ball refers to Bollinger Bands, which comment that they are 6% up than the previous day. So these things tend to help the person who is doing it get a grip of the market. So if he continues observing this throughout the day, let's see, throughout the week, sorry, as you can see here, British Telecom increased by 5 points on Tuesday, but then declined again 10 points on Wednesday, declined another point on Thursday, and another point on Friday, reaching a total of 247, which is, although it's still 237, as you 34, as you can see, the target has not changed through time. It's closer than the beginning of the week, so this trade is moving as expected. So this, despite the fact that it's just about a specific stock, can be adjusted to fit any different positions, either regarding the FX market or commodities or whatever else share you would like to trade. Okay, so take for example the Glaxo stock. So this closed at 1,674, and the support level is 1,587. So the target is 1,756, which suggests that this is a long position. So it appears that, as you can see here, this went down on the day, but it continues to go down throughout the week, which is not a very good idea, and it's in fact nearing the bottom, the support level at 1592. Okay, so as you can see here, so it started from It started from 1674 and it is now down to 1630, and it's much closer to the support level of 1530. So this is the overall grasp we get from the specific market. This is what would go on in the next years. So our trader here started from 2002, which was what we saw then, and moved on to 6, 7, 8, 10, and even today he continues to do as that. So remember that a trading journal is a log of all trading activity. Over a period of time, the journal will provide a historical perspective. So as we've seen before on this chart, we observe a history of our trades, we observe a history of what we did, and it will not only summarize our trades, but it will provide at a glance the state of our trading account. It will show each individual trade and the accumulated effects of all our trades to date. Okay, so basically what this says is that it becomes our personal performance database. It shows us how well we did, how much time it took us to go there, and so on. This will provide us with the opportunity to go back in time and determine how often we traded, how successful each of our trades were, and which currency pairs perform better for us, even the specific time frames which gave us the best profit percentages. So depending on how analytical you want to get, and depending on how much information you say you use on that specific on your specific journal, you will be able to get a great deal of information from our recording efforts. As we said, again, the journal's objective is to monitor both the performance of our trading system and our ability to execute it consistently. So the question is, are we following our trading plan correctly, or are we really trying to benefit from this? Sorry, are we really being rogue traders and we decide on the spot without following our trading plan? The difference is very large, guys. So the first means that we're doing our best, we're following our trading plan. Maybe we need to tweak our plan. The second means something totally different. We don't need to tweak our plan, we need to tweak our behavior to check if our plan is working or not. Then as I've said, poor trading systems are less frequently the case of poor trading performance, and this mostly relates to the trader's inability to properly apply the rules he himself has put down. So if we cannot abide to what we've said, then it's very, very difficult to be successful. That's what we call following the trading plan. Okay, so the trading journal is intended to make you sure that you do just that. Again, as we've said, it's a tool to evaluate yourselves objectively. I think I've said this a lot of times by now, and I really hope I can make it stick, because it's quite important, guys. It gives you a very nice overview of what you're doing. It gives you a very nice overview of what you were thinking, what made you change. It gave you a very, very different it gave you a very, very nice history of what you did. So history is important, guys. We are doomed to repeat history if we don't pay attention to it, and if we pay attention to it, we may learn a lot of things depending on the amount of detail we keep. So what I'm saying really is developing a learning loop. A learning loop really is how we measure our performance, followed by specific feedbacks about the success and failure of this performance, which should be followed by new efforts which incorporate this feedback from our performance. So what we're saying is that there's a constant loop between having a journal and our trades. So we do our trades, we see what happened in the journal, we try to tweak our behavior and our trading plan to what the journal is saying, and then we write down again, and then we try to retweak again. Basically, we build our skills on examining our practices, our behavior, our gaps in knowledge, and so on. Okay. Now, remember that journals are really as good as what is written in them. If we do not really accurately track trades, it becomes very hard to judge our trading performance. If we write one trade every 5 trade, guys, then there is no point in keeping a journal. I mean, the whole point is to keep everything as up to date as possible and to keep as much information as we can. We may miss the occasional trade. I get it. Sometimes we may want to trade from a mobile phone. We don't have something to write down, but there are other ways. You could write it down on your mobile phone. You can write it on a text message. You can send it to I don't know, upload it on the cloud and do various stuff. But the point is that we really need to be consistent with this thing. The most important statistic you can get is the dedication to our journal. So starting to maintain a trading journal should be an ongoing effort and not a one-off for the sake of completing an assignment. So this is not something, don't think of it as something that a teacher made you do. It's something that's really going to help yourself improve over the long run. So when I say long run, guys, please don't expect that you're going to write 10 or 20 trades down and you're going to see a pattern evolving in front of your eyes. It's going to take a bit longer, but the fruits that this bears are very positive. So this should be quite so this is a quite important task. Be thorough and be honest with this. So write what you really felt, not something like I did this because I thought of that, but in reality you thought of something that was completely different. So for example, don't write I acted on this because of the trading plan, while in reality someone gave you a tip about the stock and you decided to follow it. Okay. If you do not put entries down, or if you put incomplete entries, then you really are jeopardizing your own performance, and you're really putting a backstop to your own growth, as it will not be very good for yourself. So it should provide information about your plans, as we have said, and this is the most important point. So this will allow you to consider each trade before you take it by setting parameters for where you want to enter. So for example, if you write down that you buy when X ticks, okay, if this doesn't work for 10-20 trades, then you will start thinking, okay, maybe this should not be the good indicator. Maybe I should change it a bit. Maybe I should make it more sensitive. I should make it less sensitive. So this suggests that you're actually learning something from your journal. The same thing is how much risk you can accept on this trade, where is your profit, and how you intend to manage the trade. In other words, the journal again becomes a way for you to record your thoughts in actual numbers, and it makes it possible to convert our thoughts into practical reality. So overall, it forms the basis of a method for planning our trade and then trading our own plan. Now, how do we begin? Before the trade. Why? Because we need to understand our state of mind before we place the trade. So what do we write down? Pretty much everything. I intend to This is where I should go in. This is where I intend to stop out. This is what triggered us. This is what what made me think. This is what gave me a hard time. These were my um, this is what I think should go bad. This is how much I want to invest. This is how much risk I intend to take on. So we need to write observations and thoughts and feelings about what is happening. Think of it as your own personal advisor, guys. Okay, you're writing something, nobody's gonna see it, just for yourself. You write things down, and when you write things down, it makes it easier to uh, make good calls. Okay, guys. So nothing is too pointless, and what you really want to do is write what happened and why this happened. It could happen that you know what, someone called and then you couldn't write something down. It could be that you spilled your coffee. It could be that your screen froze and you made a different decision instead of what you expected. It could be a million things. You need to write everything down. Anything that caused you to have an opinion about a trade, anything that caused you to have a different view about what you are going to do. So something that you may want to consider here are some stats and some data you want to log. So for example, what is the net profit? What you intend to make? What did you make? What happened? So what's your winning percentage? What's your loss percentage? This only comes after you have started recording things down. So after you put loads of trades in your journal, you get to see how many times you were successful, how many times you lost, how many times how much money did you overall make or lose. So what was the largest winning trade, the largest losing trade? What is your average gain? What is your average loss? How much time do you usually hold your how much time do you usually hold on to a position? How much money did you make from going long? How much money did you make from going short? How much money did you lose from going long or going short? What's the largest number of consecutive losses? What's the average number of consecutive losses? What's the largest trading account percentage? Okay. What are your feelings and what are your mistakes? Now, self-discipline, guys, remember that it becomes vital when there is neither a boss or rules aiming to keep it in place. So the bottom line is that you need a trading journal to keep yourself organized and accountable. And believe me, when you start writing your mistakes on paper, you will think twice about breaking the rules or repeating the mistake, because you will see them there. You will understand what went wrong. You will understand what didn't help you, and you will try to be as consistent as possible. This is called a learning loop, what we've talked about before. Otherwise, you'll be really running in circles, and unfortunately, many times traders will be repeating the same mistakes because exactly of the fact that they didn't pay enough attention to it. Now, you should remember that your aim is to reinforce your strong points and identify your weaknesses. This can relate to a myriad of things. It could be the case that our positives are 10 and we have just one negative, but that one negative is that we enter early and we leave early from a trade, so it's not allowing us to make a profit. So if we don't have a trading plan or a trading system, then we won't be able to identify these strong points, and we won't be able to see what we like, what we don't like about trading, what the time frames are, we like to trade, and why do we do this thing. So this will actually assist us to critically review what sort of trader or investor we are, and it could actually assist us in avoiding overall avoiding what we were talking about. Finally, what is probably the most important point: every time you identify a weakness or a gap in your behavior or in your strategy that affects your trading performance, you should act on it. What I mean act on it is I mean take first acknowledge it, understand how it happens, understand what this means for you. Then there is no point in keeping records if we're not going to use them in improving ourselves and in turn improve our trading. So this is a continuous journey, and we have to live we have to help ourselves develop in our new profession. So this is remember, it could not be a profession. I mean, when I say profession, I do mean it could be like a hobby, could be interpreted as a hobby, could be interpreted as a part-time occupation. It could be interpreted as a fun pastime. It could be interpreted as a full-time profession. It could be interpreted as a million things. But you have to understand like everything, we need to pay enough attention to it in order to be able to benefit from these things. Okay, guys? So we need to keep track, and we need to continuously feel better about and improve ourselves with regards to both our trading behavior as well as to our trading plan. Now, three books that are actually quite important in helping us with our trading psychology. The first is Trading in a Zone. It actually has a very nice questionnaire. It helps you get a very good understanding of trading psychology. While the other is the classic Reminiscences of a Stock Operator. Quite interesting read, and actually provides very much it gives you a very raw insight in the world of and the psychology of a trader, of someone who can offer you a real life experience, and it actually about someone who was both successful and managed to break down in times, managed to lose it all. So it gives you also a very good understanding of of how one should manage risk. While Jack Schwager in the New Market Wizards offers conversations with top traders, which also provide very interesting intuition as to how these people understand the overall market, how they understand their overall tries to get what's best from their trades. So you will be very quiet, and it's now Q&A time. So please feel free to ask anything you'd like. Has it all been clear? Any questions, guys? For Luki, I don't have a simple template to share, but anything using the questions that we saw before would suffice. It could be just a Word file. It could be just a piece of paper where you write things down. It could be an Excel sheet. You don't have to have something very extreme. Something very simple would suffice. Just writing it down is what makes all the difference. So it shouldn't You don't need anything specific. You don't need anything very important. The reason I'm not suggesting that a template could be useful is because different people need uh, to write down different things. So it all depends on the specific trader, guys. A summary of the key elements, Netson, you mean what should be in the trading journal? This is, as we've said before, allow me to go back a bit. These are the 5 important things that you need to definitely have in. So what you intend to do, where you intend to start to enter or exit, enter and exit, sorry, how big your position should be, how are you going to manage this trade, what's your what triggered you to do this, and after that you need to put down what made you after seeing it. Basically you need to observe it again and come to a conclusion of whether this was a good or a bad idea. Okay, guys. These are just an overview of what the useful statistics you can get just by using this trading approach. Sorry, this trade journal. Any other questions, guys? So, if no more questions, guys, so remind you of the Hot Forex app, so you can fast track everything and have a look at what goes on in the markets. And we have upcoming quite interesting events. So the first is by Otto on what Bollinger Bands really do. So how do they actually work? Then we've got live this is coming up tomorrow. Then next week we've got live analysis with Stuart on Tuesday. While on the 30th of January, Andrea will go into a very interesting topic and very close to many people's hearts, whether Bitcoin will shine or dive over the course of 2019. While on the final day of the month, Otto will provide a webinar on the importance of emotional control, a theme very related also to this webinar. So, guys, I would highly recommend you had a look on this as well. So, thank you very much for your interest. If you need more analysis, please visit us on our Hot Forex analysis website, and we'll see a post soon on why actually reading analysis is a very good idea. So until then, guys, take care, have fun, and trade safely. Bye bye.